Hello and welcome to our very first edition of our weekly videos focusing on education and demystifying of the very sometimes boring topic of mortgages and protection. So this is the very first edition and this is in keeping with my promise. One of my programs on Facebook where I promised my audience, and we had an arrangement and agreement to set a task that we are going to be completing in the next week, and I set this task. This is something I've been wanting to do for some time, but for some reason I've been putting it off, and because I made that commitment to my audience on our Modesty's Monday motivational series, which I run every Monday on Facebook, on my Facebook page, on Facebook Live. I made that commitment, and here I am today, keeping to it. And thank goodness I made that commitment, otherwise this would never have happened. So my name is Ikenna Umeizudike. I am the director of Modesty Financial Consultants Ltd, based in Luton, in United Kingdom. We specialize in mortgage advice, financial advice, investments advice and planning, and financial consulting in general. So I have been wanting to really help educate my clients, my audience, and everybody out there who is interested in learning and understanding more about mortgages and protection. And this YouTube video and my decision to come and do this is based on the fact that I have noticed and realized that there is a big knowledge gap, out there for people who want to apply for mortgages or get mortgages to buy their homes. And it's one of the biggest financial decisions that people make, and it's so surprising that a lot of people make this very huge financial decision from the standpoint of ignorance and not really understanding what they are doing or what they are getting themselves into, or the details of what they are doing. And so to fill that knowledge gap, I have decided to do this every week and to churn out as much knowledge as possible out there, so that my clients will come to me from a standpoint of education, and they can make an informed decision. And I really hope that anyone who listens to this can benefit from it. And even if you don't come to me for mortgage advice or for protection advice, whenever you go to see a mortgage broker or you go to see an mortgage advisor at the bank or financial institution, you can be talking to the person from a standpoint of knowledge, of understanding, and not of ignorance, so that you know exactly what you're getting yourself into. So that's the purpose of this, to simplify and demystify the mortgage situation, especially as it concerns the United Kingdom. So that's why I'm doing this, because I want to educate my audience, I want to educate my clients, I want to educate my friends, my family, and whoever comes across this video, to know that there is a resource out there that can educate you and help you to understand mortgages in a more simplified form. So I intend not to load this presentation or my subsequent presentations with jargons. I intend to simplify it and bring it to the layman's term. So that's why we are here. And the topics I'm going to be treating now and onwards, most of them are based on questions that customers and clients have come to me asking me those questions, and I've been writing those questions down, and something in me said, hang on a minute, this may not be the only person who has this question. There might be other people like this person out there who have the same question, but they haven't got the answer, and they haven't got anyone to give them that answer. Plus, mortgage advice and financial advice these days, they don't come cheap. So I have made the decision to offer this value out there to my clients and say, hey, you can have this free of charge. It's my own way of saying to anyone out there that we can help each other. So I'm only trying to help and fill that knowledge gap. So in the spirit of this, let's jump straight into what we want to talk about today. So today, one of the questions that my clients have asked me or have been asking me is bothered on Help to Buy. So they've been asking which one is better, Help to Buy or conventional mortgage. So and I believe that this is an issue, or this is a topic that a lot of people are interested in, because Help to Buy is such a big issue in the UK, is such a big topic in the UK in the mortgage industry. So first of all, let's understand what Help to Buy is all about. So it's a scheme that was introduced by the UK government, really, to help people get onto the property ladder. You know, a lot of people were finding it difficult to get on the property ladder due to maybe financial constraints, cash constraints, not being able to come up with a deposit. And the UK government was trying to find a way to, you know, help these people, especially first-time buyers, because a lot of them were being priced out of the property market by property investors and by people who have got more cash than them. So they were finding it difficult to really get onto the property ladder. So the Help to Buy scheme was introduced by the UK government to address this issue. Now there are a few schemes that are involved in this Help to Buy scheme. You have the Help to Buy ISA, you have the shared ownership scheme, you have the Help to Buy loan equity scheme as well. Although the Help to Buy ISA, the accounts, they stopped opening new accounts on Help to Buy ISA as at 30th of November 2019. So any account that was opened up until 30th of November 2019, the Help to Buy ISA, you can still pay into that account up until November 29, 2029. So you can still pay into that account up to 10 years from 2019, really. So now let's look at this Help to Buy ISA. Even though they don't open new, they no longer open new accounts on Help to Buy ISA, but those accounts that are still open, if you're on that account, there are a few things you need to know as well. And even if you weren't opportune enough to open an account, a Help to Buy ISA account, before it closed, you can still learn, and then there's still an alternative basically to the Help to Buy ISA. So what's a Help to Buy ISA? ISA is an individual savings account. So this particular individual savings account is different from your normal cash ISA, in the sense that when you pay money into that account, it's a kind of savings. You are saving that money towards the purchase of your new home. And the government is now committing themselves to, you know, boosting that savings by 25%. So when you pay money into that ISA account, your Help to Buy ISA, the government boosts that savings by 25%. So the government gives you 25% on top of what you have saved in that ISA. That this is subject to a maximum bonus of £3,000. So that 25% is called a bonus. Yeah, so the government gives you a bonus, but up to a maximum of £3,000. Now, some of the things you need to know about the Help to Buy ISA: the minimum savings that would trigger the government's bonus is £1,600. So the moment you save up to £1,600 into your Help to Buy ISA, the government's bonus is triggered. 25% of that is triggered, but that money is not paid into that savings account immediately. The money is only available to you when you're ready to buy your new home. So for you to achieve the maximum bonus of £3,000, you would have saved up to £12,000 into that account for you to trigger the maximum bonus of £3,000. But you are allowed to pay in a maximum of £200 every month into that account. But your first payment into that account, you can make up to £1,200 payment, your first payment within the first month. So if that £1,200 goes in there, your first payment, subsequently you are allowed to pay a maximum of £200 into the account on a monthly basis. So that's how the Help to Buy ISA savings happens. Now, the other thing you need to know about the Help to Buy ISA account is that it's available to every buyer in the household. Say, for instance, you and your spouse, the both of you are first-time buyers, and you're looking to save into this Help to Buy ISA. It means that your spouse's allowance is £3,000, or bonus is £3,000. Your own bonus is £3,000. So there is £6,000 worth of bonus in that household. So it's available per buyer per household, not per household but per buyer. So there are 2 buyers in that household. Each of them is entitled to £3,000 of the government's bonus each. So it can be used in conjunction with other government schemes like shared ownership, your lifetime ISA, and your Help to Buy equity loan scheme. But you can use it in conjunction with other government schemes, basically. So the last benefit on this Help to Buy ISA will be paid by 1st of December 2030. Sorry. So by 1st of December 2030, that's when the last bonus will be paid. Okay, so any account you open before November 2019, end of November 2019, you can still pay into their account. But now no more new accounts are being opened. Now you cannot use your Help to Buy ISA bonus towards exchange, and you cannot use it towards your estate agency costs or your solicitor fees or other fees. It is strictly going to be used towards the purchase of that property. So the consolidated fund, the consolidated sum that is going towards the purchase of that property, that is what your Help to Buy ISA is to be used for. Now, your solicitor can apply for your bonus whenever you're ready to buy. You've got to inform your bank or your building society that you wish to close your Help to Buy ISA account. The account has to be closed before your solicitor can apply for that bonus from the government. So if the account is still active, it will not be triggered. The bonus will not be triggered. So you've got to inform your bank or your building society that you intend to close your Help to Buy ISA account, and then your solicitor can make application for that, and then the government will assess your situation, making sure that you're eligible and that you meet all the required criteria, and the bonus is triggered and you get that bonus. So that's really goes towards the total fund you have set aside to buy. That includes your deposits and your mortgage. So everything will have to be added to the value of your Help to Buy ISA account, and you bring all that money, you aggregate all that money, you're ready to buy your property, and then you go for it. So your bonus must be claimed by 1st of December 2030, like I already said. Now, to be eligible for this, you must be 16 years or over, and you must be residing in the UK. The house purchase price must not be more than £250,000 as at today, and if it's in London, it must not be more than £450,000 if it's in London. So any house that is worth more than £250,000, you cannot use the Help to Buy ISA bonus towards the purchase of that house if it's outside of London. If it's in London, it's £450,000, maximum value of that property. And that property must be the only home you will own, and it must be your main residence, and there must be a mortgage involved. So you cannot use it towards a cash purchase. Say you are a cash buyer and you want to buy this property in cash, then you save and the government boosts your bonus and then use it to it has to be bought through a mortgage, and it must be your main residence, and that has to be the only home you will own. So if you own any other property anywhere in the world, you will not be eligible for the Help to Buy ISA. That must be the only property you will own. Now, some people might be asking, now that this scheme has closed, what options do we have? Those of us who were not aware that it existed, what then do we do? So now that the Help to Buy ISA account, no more new accounts are being opened. There is an option, there's an alternative, and that alternative is what we call a lifetime ISAs. Now, a little bit about the lifetime ISAs. The lifetime ISAs was launched on the 6th of April 2017, by the government. The aim was to help young people to save flexibly and to save for a long term, so that they can save towards retirement or pension and towards house purchase at the same time, basically. So it was meant to encourage long-term savings, savings culture among the young people or the young ones. So for lifetime ISAs, people or individuals who are under the age of 40, if you are under 40, you are encouraged to save up to £4,000 a year. You'll be able to save up to £4,000 a year in this lifetime ISA, and the government will boost that savings again by 25%. So if you save £4,000 into that scheme, the government will give you an extra £1,000, in bonus for that. So it's really to encourage the young ones to save flexibly and to save for long term. Now, the bonus will be paid annually at the end of 2017-18 tax year, and after that 2017-18 tax year, subsequently it will be paid on monthly basis in subsequent tax years. Okay, and then this bonus will be paid to you up to the age of 50. So depending on when you started saving into this scheme, you continue to receive this bonus up to the age of 50. So the earlier you start saving into this lifetime ISA, the better. Come on, it's a bonus. The government is giving you 25%. So if you save £4,000, you're getting an extra £1,000. What stops you from doing that? Okay, so the savings into that lifetime ISA can be withdrawn after the age of 60, or you can withdraw it before you get to the age of 60 if it's to be put towards the purchase of a property. So if before you get to the age of 60 you want to buy a property and you want to use the savings in that lifetime ISA plus the bonus from the government to purchase your property, your first property or your first and only property, you are free to do that. And in doing that, the home that you're purchasing with that ISA and the bonus must not be more than £450,000. Okay, so it's a maximum purchase value of £450,000 for the property you want to use the lifetime ISA to purchase. Any other withdrawal apart from using it to buy a home or withdrawing it after the age of 60 will attract penalties, and that penalty is 25% of the surcharge. So the value of that savings will be surcharged 25%. This is to help the government recoup whatever they have put into that scheme for you, because basically you're not using it for the purpose that the government intended when they introduced the scheme. It is free money, but it is targeted at something. So if you intend to use it for something else, the government will surcharge you 25% plus an additional charge on your own savings. So the total value of that savings will be charged 25%. So you might be losing some of your interest as well in the savings if you want to withdraw that money for other purposes. So you can save into both the Help to Buy ISA and into the lifetime ISAs at the same time. You can have both accounts and save into both accounts at the same time, but you can only use one of these schemes towards home purchase. You can only use one of those schemes towards a home purchase. Yeah, so you cannot use both to say buy two different properties. If you want to use the scheme, it's either you use the lifetime ISA scheme or you use your Help to Buy ISA scheme. to buy a property if you want to use any of the scheme towards your home purchase. So the other type of help to buy I would like to talk to you about is what they call the help to buy equity loan scheme. Now the help to buy equity loan scheme is it's different from the help to buy ISA. In this case, you are not really saving into any accounts. What the government has done here is that the government is saying we're going to take a proportion of the equity in your property in exchange for the money and the assistance we're going to give to you. So basically, you just have to come up with 5% deposit minimum, and then the government will put in 20% deposits. The value of that property, 20% of the value of that property will come from the government as a help towards buying that property, and then 5% minimum will have to come from you. But then the government owns 20% equity in that property, and you are going to repay that government's part of the money 5 years after you've purchased that property. Now I'm going to break that down. So the government will lend you 20% towards the purchase of your new home. You will put down 5% or more deposit towards that, and then the rest you are going to source through mortgage. There has to be mortgage involved in this. The purchase of the property must have to go through mortgage. So if you put down 5%, the government puts down 20%. You have to source the remaining 75% through a mortgage. So a combination of your own deposits and your mortgage must not be less than 80%. So the mortgage plus your deposit must not be less than 80%. That's what it is. It doesn't specifically mean it must be 25. It must be 5%. It could be more, but the combination of the mortgage you are seeking and your own deposit must not be less than 80%, stake in the property. So there will be no fees or charges in the first 5 years, after which you will now start paying fees and charges. Now the fees go up every year. The fees you are paying to the government for the 20% proportion they put towards the purchase of that property will be going up every year, and the incremental level is pegged at it depends on what the RPI, the retail price index, does in that year. So the difference in the retail price index, by how much it goes up, plus 1% plus the 1.75% you're going to pay the government. So let me break it down. The interest chargeable on the government loan after 5 years is 1.75%. Yeah. After that year, when it gets to the next year, they will add 1% plus the incremental value or level of the RPI to that 1% on top of the 1.75%. That will be the amount of interest you're going to pay on the 20% the government lent you in the subsequent year. So it will be increasing every year. It's likely going to be getting more expensive every year. Now, but you can pay back parts or all of the government's loan before the 5 years if you so wish. Assuming you sell the property before the 5 years, you can sell the property and pay back. But what you're paying back to the government will be 20% of the value of the property when you sell it. So it then means that as your home value appreciates, so does your repayment value. And as your home value depreciates, so does your repayment value. That's a very, very critical difference, between this government loan and the conventional mortgage that you're taking out. So if, for example, you bought this property at £200,000 and 5 years later the property is worth £210,000. So £200,000 purchase price, the government lent you £40,000, which is the 20% value of the property. When you sell the house at £210,000, what you are going to pay back to the government will be 20% of £210,000, which is £42,000. Okay, now this is irrespective of how much interest you have paid to the government prior to the sale of the house. So the 1.75% you have been paying to the government plus the incremental value you have been paying to the government after 5 years does not reduce your capital liability. does not reduce your liability, does not reduce, the capital that the government gave you. The government gave you £40,000. So whatever interest and charges you're paying does not reduce that capital. It remains, static. That's just interest. Now, but buyers in London can actually get up to 40% of government help in this help to buy equity loan scheme. Now, so what it then means that the government is taking second charge on your property. There will be a second charge on your property. So when that property is being registered at the land registry, your mortgage lender will take first charge and the government will take a second charge, which means you cannot, sell that property without the consent of the government, because they have a stake in that property until you pay the government off, either until you pay the government off, either by selling the house or paying them off when you can afford to do that. So the maximum loan amounts on this help to buy equity loan scheme is £120,000 for properties outside of London and £240,000 for properties that are in London. So that's the maximum amount you can borrow from the government. If you're buying a property outside of London, it's £120,000. If you're buying a property within London, the maximum amount, not the maximum property value, the maximum property value is £600,000, but the maximum input from the government will be £240,000 for homes inside London and £120,000 for homes that are outside of London. So this loan from the government is repayable after 25 years or upon the sale of the property, whichever happens first. So the amount you're paying back is a proportion of the value of your home, like I've already explained. So this scheme started since 2013, and it was extended to 2021 by the government in 2015. So in 2015 the government said we're going to extend this scheme to 2021, but there is every likelihood, every chance of this scheme being pulled out if the pot of money set aside for it has been exhausted. The government has set aside a pot of money for this scheme. So if this scheme, if the money there gets exhausted and people take advantage of it and the money there finishes, the government can decide to pull the scheme out before 2021. So we're already in 2020. If you're looking to take advantage of this scheme, you better do that very quickly before it gets to 2021 or before the government pulls it out. So the mortgage you're going to take, the conventional mortgage you're going to take in support of this must not be less than 25%. So apart from the 20% that the government is going to give, you expected for you to qualify for this scheme. The mortgage value you're going to take, the conventional mortgage you're going to take to support this scheme and to complete the purchase of the property must not be less than 25%. And that mortgage value plus your own deposit contribution must not be less than 80% of the full purchase price of the property. Now, the maximum purchase price for both properties in London and outside of London, like I said earlier, is £600,000. And the minimum repayment is 10% of the value of the property at the time of repayment. Say, for example, before 5 years, you intend to repay part of this money, or at any point in time, you intend to repay part of this money. The minimum you can repay at any time is 10% of what the government has lent you, or 10% of the value of your property. That 10% is based on the value of your property, and that valuation has to be carried out by a government-approved valuer who will come and value your property and then tell you how much they think the property is worth. And then you can pay 10% of that. So that means you've paid half of what you owe the government, and the remaining 10% you can pay whenever you think you can. So basically you can pay in installments, or you can choose to pay the government off all in one go. Now, to be eligible for this scheme, it's available to all first-time buyers, and it's also available to homeowners who are looking to move. Maybe you are looking to move from the property you are into a bigger one, or to scale up the property ladder. Now, the home must not be sublet, and cannot be part exchanged with your old home. Okay, the home must not be sublet, and it must not be a part exchange with your old home, because the homes that are eligible for this help to buy scheme are only new builds. Okay, so there are certain developers who can part exchange your old home with their new build. This cannot be done with this scheme. You can do it if you're buying through conventional mortgage channel. So, and your new home must be the only property you own at the time of purchase if you're going to be using this scheme. The house you're buying, so it means if you have your old home has to be sold. You would have sold your old home. If you're an existing homeowner and you want to take advantage of this scheme, you would have sold your old home, and your new home has to be the only property that you own. You must not own any other property for you to take advantage of this scheme. So this scheme is only available in England, Scotland, Wales, and Northern Ireland. They have similar schemes. So if you live in that part, or if you're interested in buying property in that part, inquire about what sort of scheme that is similar to this that they run in those nations. And it's not available to buy to let investors. So this scheme is not available for people who are looking to take advantage of it, to buy properties for buy to let purposes. You cannot also rent out your existing home to buy a new home using this help to buy equity loan scheme. So for example, you want to move out of your existing home and you want to buy a new build, and you're thinking, okay, I'm going to rent out this one, I'm going to use this scheme to buy it. No. In exceptional circumstances, you can. If you are, for example, in the military, we know the military, they move them around, they post them to different places, and they have to move home, many times during their career. So if you're in the military and you fall in that category, under that kind of exceptional circumstance, the government can allow you to to rent out your existing home and then take advantage of this scheme to buy a new property, closer to where you'll be working as a military person. So there are exceptional circumstances. Apart from these exceptional circumstances, you cannot rent out your existing home in order to take advantage of this scheme. No, it has to be your only home, and the only home that you own at the time of the purchase. So if you have a land with a residential planning on it, you are considered a homeowner. You cannot use this scheme if you are in that category, if you have a land with residential planning on it. If your name is on a deed, or you benefit from the future sale of any property, you are not eligible to use this scheme either. But now for married couples, you are treated as joint owners of any property, irrespective of whose name is on the mortgage deed. So if you're legally married, or if you're a civil partnership that is recognized by the law, the both of you are treated as equal owners of the property. So it doesn't matter whether it is your spouse's name that's on the mortgage deed or not. You cannot use this scheme because you are considered a homeowner. Because you are legally married, the both of you are treated as co-owners of the property that you live in. Sorry, it's the law. It's not my fault. So if for any fraudulent claims made on help to buy scheme, immediate repayment of the bonus or the contribution or the support or the help from the government is required, and you could be liable for prosecution. Okay, so this is what we need to know as far as help to buy schemes are concerned. Shared ownership is a form of help to buy scheme, but I will talk about shared ownership at a different time. But today I just wanted to limit this to making you understand what help to buy schemes are and what's available out there and how you can take advantage of them. Now, because this has to do with comparison of help to buy scheme and conventional mortgages, next time I'm going to be talking about how you can how you compare the help to buy scheme, this help to buy scheme, with conventional mortgages, and who why help to buy scheme who will benefit from a help to buy scheme, and how it compares to conventional mortgages. And it will now give you a clearer understanding of what the difference is and what the differences are in terms of using a conventional mortgage and using a help to buy scheme. But this particular episode is just aimed at helping you understand what help to buy schemes are and what help to buy schemes are available out there and what makes you eligible for that. And once you understand that, then you can begin to put one and two together and see whether you fit into the help to buy scheme, or whether you're eligible for it, or whether it is something that you want to consider. But by next week, I'm going to talk to you about the conventional mortgage scheme and how it compares to help to buy scheme, and who exactly help to buy schemes are meant to help. Okay, now I want to leave you with the latest developments in the mortgage industry. The FCA, the Financial Conduct Authority, they've conducted a research and they've come out with a report. And I shared that report on some of my social media handles. It's an interesting report from the FCA, and what they are saying, and somehow it kind of coincided with what I just spoke about today. And to be honest with you, it was just a pure coincidence. So when I was going through that information, I was like, wow, this is really a good coincidence. So the FCA are expressing concern. They are expressing concern over people that have taken advantage of the help to buy scheme. So that report is saying that the people who have taken advantage of the help to buy scheme are more at risk of negative equity if there is a housing price crash. So for those of us who don't understand what negative equity means, it simply means that the value of your house is below what you owe on the property. So if there is a housing price crash at this moment in time, the FCA are saying that those who took advantage of the help to buy schemes are more exposed to the risk of negative equity, because it then means that even if they sell the property, they will not be able to pay back what they owe. That risk is most applicable to the portion of the conventional mortgage that they took out to buy that property. But remember that with the help to buy equity loan scheme, the government proportion that they give to you, if there is a housing price crash, the value of that property, you only pay to the government according to the value of the property. So the risk is not as much as what you owe the government, it's as much as what you owe the bank. So when you sell the house, the total loan or the total of what you owe on that property, will the value of the house sale, the proceeds from the house sale, be enough to pay back what you owe? That's how you know whether it's a negative equity or it's a positive equity. So the FCA is saying, because of the very minimal deposits requirement of people who take advantage of the help to buy scheme, they are scared for them that if there is a crash in the housing sector, their properties will be worth less than what they owe. Because if you put down only 5% deposits, for example, even if you save £12,000 and the government gave you £3,000 in the help to buy ISA or your lifetime ISA, and that's £15,000 maximum you got from there, and then you bought a property worth say £300,000, so you took out a mortgage of £285,000. So if the price of that property drops by say 10%, so it becomes like it's worth £270,000. Can you pay back what you owe the bank? You owe the bank £285,000, but the house is now worth £270,000. So it's gone into negative, equity. You cannot really pay back what you owe the bank. So that's basically what the FCA are concerned about, because there is just so little deposit you've put in there. The risk of going into negative equity is higher on the side of those who have taken advantage of the Help to Buy scheme. But that is not to discredit the Help to Buy scheme. It's just a concern that the FCA have, and the concern is valid, but then it's not an alarm. It's not. There's nothing to be alarmed about it yet, because the scheme is still there, and you can still take advantage of it, and there isn't any housing price crash yet. But the FCA are just saying, just in case it happens, because the mortgage market is very, very competitive now. There are so many lenders chasing very few buyers who fit their criteria, and it's making a lot of lenders stretch their affordability requirements a little bit and accommodating people, with a higher risk of default. So that's why the FCA are concerned, because they think that this is a time bomb. But it's a highly regulated market as well, and we believe that the people who are running it know what they are doing, and if they're taking too much risk, there are regulations out there to curtail that level of risk. But hey, if you think Help to Buy is something that you want to take advantage of, go out there and give it a go. But by next week, we're going to be talking more on this, and we're going to let you know who exactly Help to Buy schemes are meant to help and why Help to Buy schemes, and then we compare it with conventional mortgage channel of property purchase. So thank you very much for staying through with us through this first edition of our Modesty's Mortgage Masterclass. And I hope to see you again next week, and I'm going to speak to you again next week. But today we've got through the first edition, and I hope you enjoyed it, and I hope it's beneficial to you. And please subscribe to my YouTube channel, because every week I'll be on here educating you, informing you, and helping you get through all these mortgage jargons that you don't understand. If you have any question, please feel free to ask those questions. Type them in on our channel. I'm going to look at them, and I'm going to do justice to them as much as possible. Thank you, and God bless. Bye now.